There are 7 completely legal, IRS-approved tax strategies that could save you tens of thousands of dollars every year, but there's a good chance your CPA has never mentioned them to you. Today, I'm going to reveal all 7 and explain exactly why most accountants don't use them. Let me start by saying this isn't about bashing accountants. Most CPAs are good at what they do: compliance, bookkeeping, making sure your returns are filed correctly. But here's the issue. They're trained in compliance, not strategy. Their focus is on keeping you out of trouble with the IRS, not on proactively finding every possible way to reduce your taxes. The strategies I'm about to share with you were all perfectly legal and IRS approved, but they require a different approach, one that's proactive, strategic, and tailored to your specific situation. Most CPAs don't use these strategies because they either don't know about them, don't have the expertise to implement them, or their business model doesn't support the time it takes to do it right. But for you, these strategies could be worth thousands or even tens of thousands of dollars every year. Strategy number 1. S-Corp election to reduce self-employment tax. If you're a business owner making over $150,000 and you're structured as a sole proprietor or single-member LLC, you're paying 15.3% self-employment tax on all your profit. By electing S-Corp status, you can split your income into salary and distributions. You only pay self-employment tax on your salary, not on distributions. This can easily save you $10,000 to $20,000 or more per year, depending on your income. But here's why many CPAs don't recommend it. It adds complexity. You have to run payroll, file additional forms, and maintain corporate formalities. For a CPA who's trying to process as many returns as possible, adding that complexity isn't appealing. But for you, saving 5 figures a year is absolutely worth the extra paperwork. Strategy number 2. Augusta Rule, home rental to your business. Strategy number 2 is the Augusta Rule, and most business owners have never even heard of it. The Augusta Rule allows you to rent your home to your business for up to 14 days per year, and that rental income is tax-free to you personally. Here's how you use it. Let's say you hold business meetings, client events, or strategy sessions in your home. You can pay yourself rental income for those days, say $500 to $1,500 per day, depending on what comparable rentals would cost in your area. That rental expense is deductible to your business, reducing your business income, and the rental income you receive personally is tax-free. So if you rent your home to your business for 10 days at $1,000 per day, that's $10,000 in deductions for your business and $10,000 in tax-free income for you. Most CPAs don't mention this because it requires documentation and justification, and there's a perception that it might raise red flags, but it's completely legitimate if done correctly. Strategy number 3. Hiring your children. And this is a massively underutilized strategy. If you have kids under 18 and you're a sole proprietor or partnership owned by you and your spouse, you can hire them to work in your business. You pay them a salary, which is a deductible business expense. Here's the kicker. Their wages aren't subject to Social Security, Medicare, or federal unemployment taxes. And if they make under the standard deduction amount, around $14,600 for 2025, they don't pay any income tax either. So you're getting a business deduction that reduces your taxable income, and your kids are getting income that's essentially tax-free. Plus, that money can be used for their expenses, college savings, or even contributed to a Roth IRA. Most CPAs don't bring this up because it requires proper documentation of work performed, and there's a perception that it might raise red flags, but it's completely legitimate if your kids are actually performing real work for your business. Strategy number 4. Home office deduction, done correctly. A lot of business owners skip the home office deduction because they've heard stories about audits, but the truth is, if you qualify and you document it properly, it's completely legitimate deduction. If you use a portion of your home exclusively and regularly for business, you can deduct a portion of your rent or mortgage interest, utilities, insurance, repairs, and depreciation. For a business owner working from home, this can easily be $5,000 to $15,000 per year in deductions. The key is exclusively and regularly. That means you have a dedicated space for business use, not just the corner of your bedroom where you sometimes check email. Most CPAs hesitate to recommend this because they're worried about audit risk, but the IRS has actually clarified the rules in recent years, and it's much less risky than people think. Strategy number 5, Qualified Business Income Deduction Optimization, also known as the Section 199A deduction. If you're a pass-through entity, like an S-Corp, LLC, or sole proprietor, you can deduct up to 20% of your qualified business income, subject to certain limitations. But here's where it gets strategic. The deduction phases out at higher income levels, and there are different rules depending on whether you're in a specified service, trade, or business. A savvy tax strategist can help you structure your income, manage your W-2 wages if you're an S-Corp, and make sure you're maximizing this deduction. For someone making $200,000 in qualified business income, a 20% deduction means $40,000 less in taxable income. That's a massive savings. But most CPAs just calculate it based on the numbers you give them. They're not actively strategizing to maximize it. Strategy number 6, Cost segregation for real estate. And this applies if you own real estate used in your business. Normally, when you buy a commercial property, you depreciate it over 39 years. That means if you bought a $500,000 building, you're deducting about $12,800 per year. But with a cost segregation study, you can break down the components of the building, electrical systems, flooring, fixtures, and depreciate them over shorter periods like 5, 7, or 15 years. This accelerates your depreciation deductions, meaning you get bigger deductions in the early years, which saves you more money now rather than spreading it out over decades. This strategy can create tens of thousands of dollars in additional deductions in the first few years of owning a property. Most CPAs don't suggest this because it requires hiring a specialist to do the cost segregation study, and they'd rather just use straight-line depreciation since it's simpler. Strategy number 7, R&D tax credits for non-tech businesses. When people hear R&D tax credits, they think of software companies, biotech firms, or laboratories, but the IRS definition of qualified research is actually much broader. If you're developing new products, improving processes, creating proprietary systems, or experimenting with new methods, you might qualify. Manufacturers, consultants, agencies, contractors, even restaurants that develop new recipes, tons of businesses qualify but never claim these credits. R&D credits are dollar-for-dollar reductions in your tax bill. A $20,000 credit means $20,000 in taxes owed. But claiming them requires documentation, tracking qualified expenses, and understanding the technical requirements. Most CPAs either don't know enough about them or don't want to deal with the complexity. Why these strategies aren't standard? It comes down to a few things: time and complexity. These strategies require time, expertise, and customization. They don't fit the file as many returns as possible business model most accounting firms use. Risk aversion. Some CPAs are overly cautious. They'd rather play it safe than implement strategies that might require justification or documentation. Knowledge gaps. Not all CPAs are trained in proactive tax strategy. They're experts in compliance, filing, but strategic planning is a different skill set. Incentive structure. Most CPAs charge flat fees per return. There's no incentive for them to spend extra time finding strategies that save you money. They could pay the same whether they save you $1,000 or $50,000. But for you as a business owner, these strategies represent real money, and the difference between using them and not using them could be $20,000, $50,000, or more per year. How to implement these strategies. So how do you actually implement these strategies? Well, first, you need to work with a tax professional who specializes in proactive tax strategy, not just compliance. That means someone who's actively looking for opportunities to save you money, not just filing your return. Second, you need to be involved in the planning process. These strategies require information about your business operations, your goals, and your specific situation. And third, you need to think year-round, not just at tax time. Many of these strategies require planning and documentation throughout the year. If you want to start using these strategies and keep more of what you earn, Visit our website and book a free call with one of our tax strategists. We'll review your situation and show you exactly what opportunities you're missing. Thanks for watching, and I'll see you in the next one.